Are markets mispricing risk again? Hi, everyone. I'm Maggie Lake, and today I'm talking markets with Nancy Davis, Managing Partner and Chief Investment Officer at Quadratic Capital. Hi, Nancy. It's so great to see you again. Welcome to the show.
Thanks for having me, Maggie. It's great to be here.
So welcome to everyone who's joining live on YouTube and Substack. Make sure you drop your questions in the chat and we'll try to get them answered. We're super lucky to have Nancy with us today. And also please take a moment to hit the subscribe button because it really helps us out. So as a quick intro, I know many of you are familiar with Nancy, but for those of you who are not, Quadratic, Nancy's firm, has an ETF IVOL, which just celebrated its 6th birthday. So congratulations on that, Nancy. And before launching Quadratic, she was the head of credit derivatives and over-the-counter trading for Goldman Sachs prop desk. So perfect person to help us unpack what's happening, especially when it comes to the bond markets, which feel like they're kind of in a state of flux. So let's dive in. A little bit of felt like a quiet end to the week. Stocks rose modestly, finishing off what was a really good week for the S&P 500, up 5% overall. Treasury yields were little changed. I don't know, Nancy, does it feel like all the turmoil from the worst of the tariff news is behind us, or are there things happening underneath the hood of the markets that we should be aware of?
Well, it's definitely, calmed down. And I think the markets are definitely pricing not too many events. Interest rate volatility in particular, I think, has fallen to very attractive levels, especially given, kind of the unknowns around the fiscal situation, how we're going to be funding our debt and the fiscal spending. So I think it's quite interesting to be looking at, everybody's focused on the MOVE index, and that's just 30-day swaption vol and the volatility that we access inside of, our IVOL ETF. The longest dated option is trading under 3.5 basis points a day in terms of vol. So it's really, really much cheaper, about 50% cheaper than swaption vol.
So that might be over some of our heads, but we're gonna break it down because we need to understand this. But let me back up a minute on this because it seems like a lot of people are really focused on this idea of volatility and where it's going. I saw a headline earlier today that's maybe a little easier for some of us to digest, and it said the bond market is running the show again. You agree with that? And why is that? Like, why are so many people focused on the Treasury market right now?
Well, I don't know what show they're talking about. That sounds really catchy, but
True. Good point.
I don't know. I mean, I think, look, on financial television, most people love to talk about stocks because they have narratives and stories, and it's more interesting than talking about interest rates and bonds. But I do think, bonds are running the show in the sense that, most people, especially as they get closer to retirement, have a higher allocation to fixed income. So I think it's super important to be paying attention to all markets, and especially your personal situation as well with real estate. And there's a lot of focus on just the stock side of the portfolio.
Yeah, when fair enough, interest rates impact us more probably, all around. So you mentioned the MOVE index. It has been, for a long time, which is supposed to measure volatility in the stock market. And for a long time, it kind of bopped around a level that was, somewhere in the 40s, depending on. Now it feels like if you look at a chart, it's just elevated. It's just higher. It has not gone back down to those low levels. Are we in a new environment where things are just more volatile? We've seen the 10-year Treasury, race up to 5% and then back down again, and then race back up to 5% in a way that we're not really used to. We haven't seen that for a long time. Is that the kind of new normal that we're in? Is that what we should expect now?
Well, I think people get very distracted by looking at, some of these like equity volatility, like the VIX or the MOVE index. I think the thing I try to really emphasize to people is that core fixed income, as defined by the AG index, 27% of it is US mortgages. And so you might not realize, but everybody out there, for the most part, is short fixed income volatility because think about it. In the United States, homeowners are long the option to prepay. And if you own a mortgage, you're short options to homeowners. And whenever you're short options, very simply, you're short vol. So selling options is selling volatility. And so I think people are kind of missing kind of the bigger picture that, unless you're actively adding interest rate volatility or fixed income volatility to your bond portfolio, you naturally have this embedded, call it, almost 30% of short volatility exposure. Plus then you add in all the credit exposure and, all the other structured credit products that are out there that are, spread risk, right? So if you have equities and you have a bunch of bonds with credit spread, you kind of have the same corporate beta, right?
Mm. Yeah. Well, we've talked about this idea that you think you're diversified, but then you find out when you look at it through this more complex lens, like maybe you're not, which is a problem, I think, for all of us. So talk to me a little bit about how IVOL fits into this, because you and I have talked in the past, and as I've been watching what's happening, I was thinking, like, gosh, it feels like you made the ETF for these times. I don't know. I'm sure you don't have a crystal ball, but why did you create that? And what do you see in the market that's missing? Like, how do we need to understand what we should be doing with this exposure you just explained we have?
Well, I think the big thing is people use IVOL to complete the AG. The AG index is what most core fixed income portfolios are benchmarked to. And like we just talked about, 27% of it is mortgages, which are homeowners are long the option. If you own the mortgage, you're short the option. So that embedded short volatility, plus the AG has no inflation protection. So that's kind of crazy to think that you have core fixed income, and especially in today's environment, to not have any inflation protection. So we take TIPS, which are, Treasury inflation protected securities. So they're just Treasury bonds that reset with CPI. And then we don't think CPI is the only way to measure inflation. And then we add fully funded options to fix the duration problem with TIPS. All TIPS are long duration. And B, to access another index outside of the consumer price index. Like if you compare it to the equity world, nobody would ever buy, one equity index to get the stock market. And the stock market should be pretty easy to measure, right? There are only a handful of publicly traded companies out there, but nobody would buy the Dow Jones or the NASDAQ or the Russell. And, we've heard from Chairman Powell for years that even the Fed doesn't use the consumer price index. So you hear about these products out there like inflation swaps or CPI swaps. It's all going back to that same index, which is calculated from the Bureau of Labor Statistics. And the bulk of that index, about a third of it, is rent, right? And it's not the only way to think about inflation. And that's what we do with IVOL is we take that core TIPS portfolio, and then we add fully funded long only options, which are long interest rate volatility, which is nice to have to offset the AG. And it's long inflation expectations outside of CPI.
I feel like we have so much work to do to sort of educate ourselves on this, because the idea, so are you talking about when you say like you'd never just buy one stock and think, or one index and think that you have diversity across the equity market? Is that what we're doing when we're buying TIPS, or is that because everything's benchmarked, every product out there, or most of the products out there are benchmarked to CPI? Why is it like falsely simplistic, even though we think we're doing something smart?
Well, the TIPS market is pretty new. The Treasury started issuing TIPS in the late 90s, and TIPS reset with one index, which is the consumer price index, and that's it. So whether you're looking at inflation swaps or break evens or CPI swaps, it's all going back to this one core index, which is the consumer price index calculated by the Bureau of Labor Statistics, which a very large chunk of it is rent. And so we use the interest rate markets to capture inflation expectations outside of CPI. Now, if you look at the fund's performance, it did very well in 2020 and the first quarter of 21 when TIPS lost money on their duration. We were up, but then really since the Fed flipped from not even thinking about raising rates to hiking rates, and then went into the fastest hiking cycle, even more so than Volcker, that inverted the yield curve. So the yield curve has just started to normalize. So we're really excited about the fund. It's up about 10% year to date. but it's been down for years with this inverted yield curve. So we're just getting back to normal. And I think that's the thing I like to highlight to investors is we don't need, if we have stagflation or if we have a rise in volatility or if we have, kind of a risk off environment like 2020. In March 2020, we outperformed tips and did well in all the risk on environments too in 2020. But it's really capturing, something that, we have data on the yield curve going back to the 70s, and the yield curve never inverted for that long and that low of a level. So it's been, I think it's a good value, but for people out there that are looking for momentum, it might not be, their jam.
Yeah. Yeah. Listen, I think even for people looking for momentum in this kind of environment with this level of uncertainty, I think a lot of people also want some sort of, we've seen safe havens rocket, right? Because I think some people also want some sort of insurance or some sort of, diversification or protection at the very least. Do you feel like we are entering a stagflationary environment or an inflationary environment? There seems to be a huge amount of debate about this.
I think one of the things that we do with IVOL is we're not taking a macro bet about what's going to happen. We're giving people a way of, expressing their own view, right? So the yield curve right now, the 2s10s curve, which is what we own options on, is currently 13 basis points. If you go back to the 1978 when the swaps market started, you can see on average it's about 100 basis points, and the high was about 300 basis points or 3%. So I think in a stagflationary environment, all the ways that we do well would likely work. You'd likely see much higher interest rate volatility, especially when we're coming off a base. Like I said, our longest dated option is priced at under 3.5 basis points a day in terms of its implied vol. That's not very much. Like just today, the market, the 2s10s curve moved more than 3.5%. So it's unusual to have implied volatility trading below where we're realized has been kind of on a almost daily basis since Liberation Day. And then the yield curve probably will steepen in a stagflationary environment. It could be either from the Fed cutting rates to stimulate growth or from the rest of the world demanding more yield to own our debt. So it's either or. And I think that's the thing that's so nice about it is you don't have to take one view. It can either be front dated yields moving lower or long dated yields moving higher. And then stagflation would be especially bad probably for credit. And I think that's one thing, 99% of investors who take risk in bond markets outside of, their duration risk, all bonds are long duration, is they take credit risk, and credit spreads are very, very tight across the board. There's been a huge, kind of surge of AUM into CLOs in particular. And if you look at the option adjusted spread, the credit spread inside of CLOs, which are pools of levered loans, it's trading around, 110 basis points right now. And so with credit, you want credit spreads tighter. And when they're so tight already, there's not, it's potentially more risk than reward. Whereas we trade spread too, but our spread is on interest rates. So just something different. And we want that interest rate spread to widen. So currently, like I said, the 2s10s SOFR curve is 13 basis points. That's much cheaper than the Treasury curve, which is right now 45 basis points. And we want that spread to widen. And we don't really care how it happens.
Yeah, it's interesting to hear you say that it doesn't matter how you get there. It's not really a macro bet, because I feel like so much of what we see is really driven by people who are so locked into their narrative about what's going to happen. That whether it's a great exodus out of the US and the end of US exceptionalism, or, that there's a, fiscal time bomb ticking, people are very, very married to that. Interesting to have a concept where it doesn't matter how you get there. You're just sort of thinking about what the end result is. I just want to go back to the credit spreads for a moment. Does it feel, people have pointed out the fact that they seem really tight, given what's going on. Does it feel like that market or it is adequately pricing the risk out there?
Well, no. So a lot of people, because we just came out of such a steep hiking cycle, a lot of people are kind of scared of duration risk, right? So a lot of money has been flowing into short duration bonds, but short duration bonds are not, they're not short duration, they're just less long. It's kind of a misnomer. And because there's so much money flowing into that market, the credit curves are upward sloping. So what that means is if you look at like a 2-year investment grade spread, currently the 2-year CDX is 25 basis points, right? It's impossible to go to zero. It can't go to zero because it has to trade at a spread above risk-free, which is Treasuries, but 25 basis points is super tight. And then if you look at CLOs, like a 5-year CLO, levered loans, a pool of lever loans, it's not really anything super special. And it's trading at around 110 basis points of spread. So with credit, anything with credit, you want spreads tighter and yields lower to make money. With IVOL, we don't really care. We're agnostic to the level of interest rates. We just want the spread between interest rates to widen. And we don't really care how that happens. It could be the back end yields moving higher or the front end yields moving lower. It's kind of like either way. And I think that's the nice thing about the fund is all bonds, you're kind of taking two uniform bets, which is interest rates lower and credit spreads tighter. For us, it's just something different.
So I'm listening to you talk about this. I don't know if you remember telling me this story, but I think it's a good one to slide in here because, I mean, there's definitely a level of sophistication about how you're looking at the markets and what you're using. And correct me if I'm wrong, but when you were on, I think it was maternity leave, you were sneaking into the Greenwich Library because they had a Bloomberg to trade to look at your derivative trades or something like that. Am I remembering that correctly?
There you are, Maggie. I did have a period where it was actually when I had a period in my career in between when I went from Goldman Sachs. I was there for about a decade to JP Morgan's hedge fund. And, then I had a period where I was home with my kids. And so I would take my kids, my little babies, to their preschool class. And I had about 2 hours a day. And I would go to the Greenwich Library and I would trade structured products on the secondary market, which are, zero coupon bonds coupled with packages of options. And so that was kind of the moment where I was like, wow, I really like doing this. Like I didn't just fall into this job and do the job because, when you do something for free, for fun, in your free time, like I know that's not normal. Most stay-at-home moms that I knew would go do yoga or Whole Foods or Le Pain Quotidien or go to the gym, not normal to go. And I don't like trading structured products on the primary market because there's such a huge fee that the dealers charge on these notes. I like trading them on the secondary market. And this was before kind of Dodd-Frank had automated everything. So dealers would send out these runs and you could price up the true value of the note and I would just bid lower. So in a weird way, I think I made more money, working a couple hours a week for myself trading from the Greenwich Library on a free Bloomberg terminal than I would have if I'd stayed at Goldman Sachs for that period of time.
Crazy. That's crazy. I wish someone had a picture of that. I can imagine what the conversation was happening in the library. Like, who is this person that keeps coming in? Who knows if that library, but don't stampede it, people. We don't know if they still have that terminal.
They have 2 Bloomberg terminals.
They have 2 now. Well, obviously Greenwich is doing
They
well.
had 2 back then too. So.
Yeah, because that's not a cheap thing. I think that's a great story because obviously it takes a lot to understand these markets and especially when it comes to things like derivatives and some of the more complex things that frankly, a lot of us, it just doesn't mean anything to us. We just don't have access to it. Do you see any signals coming from the options and derivative markets that we should be paying attention to?
I mean, I don't think people have any idea that there's so many products in fixed income that use leverage. And I think that's one thing we are very, very conservative at Quadratic. We only use fully funded options inside of our ETFs. So there's never an obligation on the fund for cash. And I think anytime you have cash obligations, and it could be futures where you have a margin call or swaps where you have a counterparty do a margin call, or if you sell options, you can have margin calls. I think of it as kind of like debit cards, where we always fully pay upfront for what our max loss is, and we can never lose more than that. So I think derivatives do have a bad reputation for a good reason, but I don't think these products, especially with ETFs, like CLOs, have options inside of them. There's an options adjusted spread that you should look at for credit. People don't have any idea that it's a structured product and that it's a pool of levered loans and how these instruments actually work. Even mortgages, I think people don't understand that mortgages have that embedded short optionality from homeowners being long the option to prepay. And you would think that would be so obvious because most people either rent or buy know that mortgages have that prepayment risk. But it's kind of challenging because inside a lot of these fixed income instruments, you see very complicated, very negatively convex products like CMOs. Really, really complicated instrument. It's truly Adult Swim, but they're kind of common knowledge and in all these funds that might say short duration, but you don't really know what's under the hood.
That makes me really nervous because I love Adult Swim, by the way. We're going to do something called that. You heard it here first. And Nancy, you could be the co-pilot on that, because Lord knows you're talking about stuff that's we're struggling to keep up. But that makes me nervous when I hear that, because it reminds me of when things blew up. And I'm not being alarmist here at all. I just want to, but we just try to make sure that we have our eyes wide open. And when we think about what happened back in '08, it was because there were all of these sort of bundled loans and all sorts of CDOs and all kinds of collateralized stuff that people didn't really understand. Everybody was selling it like lollipops on the corner, and we were all holding it. And then and then the floor dropped out. Is there, I don't want to say too much leverage in the system, but is there risk around the leverage in the system that may not be well understood?
Yeah, I think there's a lot of risk, and it's also relative to, the global economy. It's not just US investors, banks. CDOs were kind of the villain, right, from the financial crisis, but CLOs now are held out as this like magic unicorn, can't lose money. Yes, they didn't default in the financial crisis, but everything has gone from covenant light to no covenants. And, Japan is the largest owner of CLOs, and then Taiwanese life insurance companies outside of just the banking system. And a CLO is just, instead of being a pool of debt instruments like a CDO, like bonds, it's a pool of levered loans. And so it's not anything kind of unique or special. And I think people just don't understand some of these instruments that have become popular, especially, I love ETFs because I do think they're a way of, democratizing financial markets and giving transparency and liquidity. So I'm not saying anything about ETFs, but I think there's so many strategies out there, especially, all these option strategies inside of ETFs that are essentially structured products. And I don't think people really understand what's under the hood.
No, we don't. We don't have any idea. I'll tell you right now, because we think of it as just a way that we are able to get in and out of equities, or a basket of equities, in a way where you would be trapped by a mutual fund before. I mean, I think people think it's as straightforward as that. I don't think they understand the risk. What would, I don't know if this is an answerable question, but what would trigger, I mean, you've obviously thought about this because you've structured your ETF in a way where you don't have that exposure. What macro environment would trigger a problem with leverage? Interest rates?
Anytime you need cash. So I think the problem, like we have OTC options inside of our ETF, right? They're accessing the interest rate markets, which is the biggest market in the world. It's, the interest rate swap market is approximately 5 times bigger than the stock market. And no one really has exposure to it because it's not accessible without having ISDA agreements. But sometimes I get the question about like, oh, well, you have counterparty risk. I'm like, well, if you're accessing listed options, you have counterparty risk too. It's just a single exchange. And so I think it's just so important to not get hung up on what happened in the past. I think people kind of get caught up with what took place in '08, and they're not looking at what could take place in the future. And anytime you have, any type of short option, anytime you hear right or buy right means selling options. And it's not always a bad strategy, but you should just understand that when you're selling options, you're selling volatility. And I think our fund is very simple because it's long only. It's long treasuries, it's long cash. Per our prospectus, 80% of our fund must be long treasuries or cash. And then it's long only options, which, you can lose money in options for sure, but you always know how much you can lose. And I think that's an attractive, thing, because most people, especially in their fixed income portfolio, have that embedded short optionality.
Yeah. No, that's a great way to look at it. And this is where I think like the knowledge gap falls out for us, just because we're not looking at the full picture of diversification. It seems like it's much more multi-layered. We have to think about it that way.
Yeah. I mean, none of these strategies are bad. It's just you want to make sure that you don't have a lot of the similar betas inside your portfolio. And if you do have these kind of more complicated fixed income products, just don't go by just because it says short duration. You have to look inside of it. And is it AAA credit? Is it securitized credit? Does it have acronyms in it that are like, structured credit? And just understand what the risks are.
Yeah. All good things, folks, to roll up and ask your financial advisor when you're looking at your portfolio. If you have fixed income exposure, bond exposure, to be asking some of these. These are kind of smart questions that you can ask. And if they don't know the answer, then that should give you cause for pause. Nancy, do you think that we are in a situation where we're vulnerable to the bond market, like the return of the bond vigilantes, I guess is the way to ask that, that we could see the bond market? I think Tommy Thornton was in our chat earlier this week, and he said the bond market is now the adult in the room that's going to impose fiscal discipline on DC. And if they don't get it, you're going to see the market sort of vote with their feet. Are we at risk of the rates on treasuries really marching higher here? I know your IVOL is agnostic about what causes it, whether it should drop on the front end or longer on the higher end. But how do you feel about the risk to the 10-year?
I mean, I think we do have, the Fed has stopped doing their QE purchases, right? They're still doing QT on the mortgage side. The Fed owns, $2.2 trillion of mortgages, they've said they don't want to own mortgages long-term on their balance sheet. And then we have the rest of the world that is kind of financing our debt, whether it's Asian investors or other investors out there. So I do think, look, it's something to be concerned about. But I think in that, my opinion, I think it's easier to have a view on the curve when normally the curve, on average, going back to the 70s, is about 1%, right? I lend you money, Maggie, for 2 years versus 10 years. If I lend it to you for 10 years, you would expect to get 1% higher, in terms of the payment, the interest rate that I charge you. Right now, that spread is 13 basis points, which I just don't think, that's not normal. So I think the thing that I really like about our strategy is we don't need, if we had stagflation or a risk-off environment or, kind of this bond vigilantes, that would be great because that would make interest rate volatility go higher and likely make the curve steepen. But the curve can steepen just getting to a more normal environment. And that's what I try to stress to people is we don't need some kind of crazy tail event to happen to do well. And it's nice because front end yields going lower typically happens in a risk off environment. So it could be a potential good hedge for, just owning volatility and having that cut as well, especially because the Fed, Powell has really moved the curve. Think about 2024 coming into 24, the market had priced in 6 cuts from the Fed. Those did not all materialize. And now we have, much less expectations than we were even on Liberation Day. So right now in 25, we have about 2 cuts priced in for the whole year.
Yeah, and we'll see if we get them. Kirk asking, any thoughts on the recent weakness in the 30-year swaps market, and if this is isolated dislocation or more of a signal of more systemic problem in the credit markets? Kirk laying down a good question. Thank God for you. Nancy, thoughts on that?
Yeah, swap spreads are very negative. So the 30-year SOFR spread is negative 85, which is just a sign of liquidity, right? When people go to the Treasury market, they have to put up cash, right? They have to physically buy the market. And the bond market is wildly levered. Think about all the people in the world who invest with futures or they invest with swaps. And so it's just a sign of the need for duration and not having, in my opinion, the cash to pay for it. Of course, if you buy a Treasury, you can repo it out, but people use the swap market for leverage. And that's why inside of IVOL, we like having options on the swaps curve and not the Treasury curve, because it has that embedded credit exposure as well, because we want spreads to widen. So I think it's a lot better than using, the Treasury curve, which is in theory risk-free.
Ched Singh, another person who comes on, Chem Carson, has said for a little bit that options markets have become the tail that wags the dog, stocks, versus decades ago when it was the opposite. Thoughts on that?
I mean, I think those statements sound pretty catchy. I mean, I don't think it's a tail that wags the dog. I think there's a lot of, trading that does take place in options. And I think these 0-day options, especially in the equity options market, has kind of made it a little, anybody can do it now. I think the thing I would say is people get very focused on equity options. And I think the thing I like to explain to investors is your bond portfolio, because of that mortgage risk, any place you have mortgages has that embedded short option. So the thing that people really should be thinking about is the fixed income side of the options exposure that they have, in my opinion. And that's not, it's in all institutional investors are all benchmarked to the ag, right? They all have that as core fixed income. So adding inflation protection or adding something that's not short volatility adds tracking risk. And sadly, the way consultants and other investors on the institutional side are measured, it's all their tracking risk. And so I think it's super important just to say, look, maybe you look under the hood and see what you actually have inside your portfolio.
I want you to break that down, because I think you just said something so important. Hey, Katie Stockton's in the Substack chat. Hi there. Talk to me again. Repeat what you just said and explain it, if you could break it down just a little bit. And we're almost out of time. So I think we're going to end on this really important point, because I feel like this is something we can all take away when we go and look, you get those perspectives. We all throw them in the trash. They have so many sort of small print listed things. And even the most sophisticated among us do it, right? Because we're just really short on time and we have some level of trust that we made a decision to put our money here and we feel pretty good about it. What do you mean that they are judged by their tracking? Explain that, and why is that maybe a blind spot?
So it's this push to indexing, right? This push to having, people use the Barclays Ag, which is now called the Bloomberg Ag, which used to be the Lehman Ag, this index to express core fixed income. Now it says core fixed income, but how can it be core fixed income when it's only short volatility in fixed income and it has no inflation protection? So people get kind of caught up with these having a benchmark and outperforming the benchmark and not having tracking risks to the benchmark. And so a lot of our investors will take the ag index, their core fixed income, and then they add IVOL to reduce the embedded short optionality. That 27% of that index is mortgages, which are short options, and they use it to add inflation expectations, CPI plus inflation expectations in the rates market. So my point is that your pension fund, our mothers, our fathers, all these people are sitting in core fixed income, which is really like a misnomer. How can you be core fixed income and only be short vol and only not have any inflation protection? It's just these old indices that there's no tips in core fixed income.
Yeah, it needs an update. And I understand that, Nancy, which is fantastic. And I think we all do. Every time I spend time with you, I'm just blown away by your depth of knowledge. It's incredible. And I feel like I'll have Nancy back and she'll draw it out for crayon for some of us again. We're gonna keep going back over this because I think it's really important. But these are blind spots we have, and it makes me nervous. And I feel like we could sort of up our game and be smarter. And you really help us do this. And I know some of the areas that you play in are it is Adult Swim and very complicated. But you broke it down wonderfully for us today and gave us, I think, the crumbs to keep following so that we can be a little smarter about this. So thank you so much.
Thank you for having me on, Maggie. It's great to see you.
Yeah, same here. Incredible stuff. If you have follow-up questions, if you digest this and then realize a light bulb goes off, drop comments for us on the posts on Substack or on YouTube. We will chase them down. We'll get in touch with Nancy and we will follow up. And we'll do this again. We're gonna crack this part of the market, Nancy, with your help. So thank you.
Awesome. Thank you
Great
for
stuff.
having
Have
me.
a great weekend. Thanks, everybody. Join me on Monday. I'm going to catch up with Juliette DeClercq. I'm actually prepping with her on the weekend, but we're going to have a great chat. And she's got a new report dropping about everything happening in the macro world that we just talked about. Really anxious to catch up with her. We have a link to the SIC conference if you haven't joined up so you can participate. Pippa Malmgren is going to be there in the morning too. So get your tickets. If you use our link, we get a commission. Just be aware of that. But we hope to see you there. And I hope to see you in the chat. We're going to take questions on that too. Have a great one, everybody. Take care and good luck out there. Thanks, Nance.
Thank you.